I think that we all have to acknowledge that today high-frequency trading, a super fast set of algorithmic trading, has become a predominant form of trading in EU equity financial markets. Mr. Filippo now was referring this just a moment ago. Significant concerns have been raised about the quality of the liquidity provided, as well as the risks posed in terms of stability and integrity for our financial markets by this type of trading.
The issue of orders sent without a real intent to trade. We think now we are pretty sure that there are some orders like that. And of course, here again, it changes how you can appreciate the functioning of the market.
If you want to avoid that, for the moment, more than 90% of the orders placed in high-frequency trading are withdrawn before execution, you have to think on whether a minimum holding period makes sense or not. I'm open for every kind of slowing down this thing. If other ideas are on the table, I appreciate that, but I think we want to throw a stone in the sea, and that is what the Parliament accepted, to have a minimum resting period of famous 500 milliseconds. The average placement for the moment is 5 milliseconds, and maybe that gives you a thinking of how we calculated 500.
The question here is market structure and technology, who benefits? Well, it's very interesting because I think that our main thesis is that the market participants don't benefit, actually, because it makes markets more efficient, i.e. less beneficial for the less beneficial for the intermediaries. But as a result, it's more beneficial for end users. So pension funds and, for example, retail investors. Looking at institutional commissions in Europe, I used to run trading at Goldman Sachs. In Europe, we were charging clients in 2000 around 25 to 40 basis points, so 0.25 to 0.4 basis points to transact their trades. Were all done over the phone. We call it high-touch business. And today, markets have changed significantly. We estimate 60, 70, sometimes 80% of the business is done through algorithmic direct market access at rates as low as 1 to 3 basis points for execution-only business. Huge savings for end users.
And then going back to the spread, one other point, is a spread really a meaningful notion anymore? Does it really matter if the spread is a penny when there's really not a quote there, right? A quote in the olden days, right, when there were specialists with guys, and by the way, if you look on CNBC and you see those guys running around the floor, that's not where the stock exchange is anymore. It's in Mahwah, New Jersey. Okay, come see it. It's a big warehouse.
A lot of these high-frequency traders, they're bid on BATS, Chi-X, they're also bid on the primary exchange, they're bid on turquoise. And the moment you hit them on one, they cancel all. So that happens to us every single day. We'll see 5,000, 10,000 shares in the bid. We do an IOC for 20,000 shares. My fill is 3,000 shares.
Yeah, I think
what happened
that's
to the 17?
The trading desk have been, just erased because expense cuts, right? So the 1 or 2 traders that are left on the desk now have to deal with algorithms supplied by brokers. The algorithms, unfortunately, do have lots of conflicts of interest. To get through that maze, that you're looking at, you have to make pit stops along the way. So by the time Mike's order may go through an algorithm, it's been sniffed, pinged, prodded, and everything else. We call it the sweaty handshake. And by the time it comes out, it's pretty ugly, so you have to be really careful. But your real cost of a trade is not the 30 bips that you're going to pay for the algo. That's not the cost. The cost is actually putting on that execution, and those costs have gone up.
But that's not what ITG or Elkins and Sherry or Able knows or say. So I don't understand.
Well, your shortfall chart was actually very similar in pre-2007. The implementation shortfall was still around 20 bips from what I can see. So it really hasn't changed with the advent of all.
You're saying the cost has gone up, but that chart clearly shows the cost has gone down. And
I think that
Elkins McSherry says that as well. In 2011, they said that trading costs for U.S. institutions gone down 6% each year since 2006. So I don't understand where you're basing your data on.
From an explicit cost, trading costs have come down dramatically. There used to be a nickel commission.
But I'm talking about market impact.
But if you go back to your chart, if you pull it up, the implementation cost, if anything, was the same as it was 6 years ago, except for that spike back in 08, 09. It was the same. So I don't see the benefit that we've gotten from
You're
all of
saying it
this.
has gone up, but where are you basing it on? If the three largest
There are some
transaction cost
studies.
analysis firms
I'll concede the point that they've
say
remained flat.
something different.
I'll concede the point they remain flat, although I can't tell you some studies. But if they have even remained flat, what advantage have I gotten from all of this spread narrowing? What's the big advantage I've gotten?
What I want to talk about is what is slippage. Slippage for us means that basically someone has detected your order before you can complete it. The examples I give start back in the 1990s. When I began my career, we would pound the table furiously with our phones when trying to execute orders in the Italian bond futures pit in London. I used to work on the floor in Chicago in 97 and 98. So, I've seen this a million times, which is the market makers down on the floor of the futures exchanges would move the market away from you before you could execute the balance of your order. And in today's market, the perception that we have is that the high-frequency trader has inherited that behavior. Now, this is subject to debate, but that is our perception at this time.
When we talk about HFT, we have to accept the fact it is not a trading strategy. It is not now and it never will be. What HFT does is it allows you to do old trading strategies, some of which have existed for hundreds of years, at a different sort of speed. So when we start knocking HFT, might be fair enough. Might be reasonable if somebody's using high-frequency technology in order to abuse the markets. Maybe they are front-running in the genuine criminal sense of that word, and I agree with you, Mark. I hate the use of front-running as a phrase when we don't actually mean it in that legal sense, because that blurs things and it makes it a motive. So if it's used for front-running, that's bad. If it's used for gouging people, that's bad. If it's used for market making, and there are market makers, IMC is one of them, that are official market makers in certain instruments on certain markets, well, generally speaking, don't we think that's good? Isn't that one of the things that the Commission and others have written into the new MiFID proposals, that we will encourage liquidity provision? Kind of depends which faculty of HFT you're looking at as to whether it's good or bad.
Again, the impact on the microstructure of the market is high. And we're really seeing that the microstructure of the markets is something the regulator should look at, because it is a key element for the good functioning of the market, and this is our mission. But on this precise issue, this is in fact an economy. It is not something moral, or it's an economic issue. If you want the supervisors to be able to detect sanction, market abusing using technology, high technology, we need to be equipped with a lot of technology. Okay? It has a cost. So the question here would be, if you think that it is still necessary to fight against market abuse, of course, and especially market manipulation.
We think we probably have the highest quality surveillance technology in Europe. And one of the reasons that we think we've got that is right from the start, what we tried to do was ensure that we could actually surveil across market. Now, obviously, in our own market, that's the only place that we can see all the names of the parties that are trading. But because we also take the market data from all the other markets, the way surveillance work is that it's about pattern recognition. You have your own algorithms that look for behavior that you don't want and you want to eradicate. And we've had experience where what we are able to do is identify someone and stop them trading on our market. But then we saw, because we're taking all the market data from the other markets as well, we saw the same pattern, and we were able to liaise via the FSA with other regulators to actually stop this on other markets as well. So we've already tried to facilitate the sort of cross-market surveillance that Thierry was talking about.
I mean, we need to frame ultimately this race to zero, no? The race to speed that has become absolutely incremental and that has posed questions, as Mr. Philippon mentioned, about the incremental benefits in terms of more efficient price formation mechanism and market liquidity. There are questions as to whether this rush to immediate action is actually contributing to welfare and the well-functioning of financial markets.
Does the cost of this arms race I've expressed earlier is economically beneficial for the community?
I mean, these are very costly investments, even for the brokerage community, yeah? I mean, the return on equity of the asset management industry is, often not as high, especially in my company, is not as high as that of the brokerage community or perhaps even HFT or exchanges. So if you want to have an arms race of technology, we likely cannot compete.
Liquidity has to do with how much depth there is in the order book. And technology, again, has brought huge improvements to this. So this is a figure, the Xetra liquidity measure that's published by the Deutsche Börse, which shows that in some cases, liquidity has improved by 3 times. This is just, by the way, Deutsche Börse. This is not taking into account, you now have other venues that you can transact your shares in as well.
At what's it actually doing in any given market, because, as you say, you go to India, it doesn't even exist. So the role of HFT differs. As far as I can see, on the whole, it's probably beneficial for markets around spreads, around depth, around liquidity, if the markets are sanguine. When we come to stress periods, it's more complex. I think that's definitely the case.
We only want to interact with counterparties that are like APG. So think of the Norwegian Pension Fund, JP Morgan Asset Management, Templeton, whatever. Do not force us, please, to interact with HFT or to interact with someone who claims to be a market maker, ELP.
What is the economical impact of this provided liquidity if most of the, according to studies I have on my desk, most of high-frequency traders want to leave the marketplace in the evening only with money, but not with shares. So the economical impact is that they try to jump in orders which are really taking place and try to benefit out of that. And the addition liquidity is only disturbing, or can disturb. It's not only this, it can disturb a fair price building process, and that's why I think it makes sense to take influence on that. Everything which has a price is a market-driven procedure, as prices are defining what's happening on the market. And if you give rebates, you are taking influence. If you give additional fees, you are influencing as well. So for the moment we have more rebates, but maybe it makes sense if you have a higher ratio of withdrawn orders before execution, that this kind of strategy is reduced and makes then less problems in a fair price building process.
I say to limit the possible negative impact of high frequency trading. I do not say to stop the high frequency trading. Could be to introduce a new tick size regime. We have noticed by our studies that the tick size regime has a great impact on the functioning of the market, and especially on high-frequency trading.
I do think that tick size is something that needs to be looked at, and in the SEC, under the Jobs Act, which was passed and signed by President Obama back in April, had a mandate to look at that and say, would a widening of tick sizes actually increase liquidity, was the question. Would that help? And the theory goes, if you widen tick sizes, you will encourage more displayed liquidity providers to come back to the market because they will now make the spread. That's the theory of that whole widening of ticks. The SEC punted and will come up with some roundtables eventually and decide. But we think a pilot program there would be a great idea.
My view is more that they should be proportionate. Because the thing is, the other argument is if you
proportionate
just
to market cap?
proportionate to activity.
Right, so let's take a small cap stock that trades, and I agree with that. If it's small cap stock trades 50,000 shares a day, that should not have the same tick size as Apple, which is trading millions of shares a day.
Yep.
But we also think, and I think someone brought this up earlier, the issuer, maybe this was Mike with his comment, the issuer should have a say in the size of the tick.
I could have two firms and say they're both at an order to trade ratio, say one's at an order to trade ratio of 100. Yeah. Now, if they're quoting an enormous spread, that's much less value to me than someone who's got an order to trade ratio of 150, who's trading at the best bid offer all day. So you would find the guy who's really being the market maker, who's really there all the time, and not the guy who had the really useless quotes. So that's what we're doing as a detailed way of managing our markets all the time. We're sort of saying, look, that's where our costs are driven from those orders. You're not being much use to the market because you're quoting too wide, or and we're trying to emphasise the market makers. When we went into Spain, and we had massive support for going into Spain and trying to open up that market, when we started quoting on some of the most common stocks, we had terrible order to trade ratios. And the reason is because the market makers were doing a fantastic job. They were keeping our market right in line with the Spanish market all day. It's that we just didn't have the new volume to actually hit those market makers. And so these things are subtly anti-competitive, they can be anti-competitive, they can be very clumsy implementations. So they sound attractive, but really the devil is in the detail because of what the impacts they have. So when we come to those things, I'd much rather have a very detailed conversation with a regulator that says, why have you got an order to trade ratio on this market that's different to that market, or and go into the detail with them rather than just having a tax put on from a distance which doesn't understand the detail.
Mark, doesn't it also become a bandwidth issue? And I think at least in the US, if there is a certain amount of bandwidth, if a regulator needs to now increase their capacity to look at these quotes, or if a exchange has to increase their capacity to process these quotes, that costs money. So if someone is using more bandwidth, they should, just like a cell phone, you should pay for the bandwidth that you're using. I think a cancellation fee goes at the heart of it much better than a transaction tax overall, because a transaction tax discourages investment, discourages long-term investors, discourages retail investors. That's not what we're going for. We want to equal the system.